The next set of videos that we're going to talk about now, this has to do with the tax consequences, really, of selling an asset that you already own. And these would be depreciable assets. So these would be assets that you bought a number of years ago, perhaps. You've depreciated them, and now you're selling them. Anytime you sell an asset for more than the original depreciable value of the asset, there's going to be tax consequences. And so this set of videos that we're going to go through here now, this is trying to show you how it is you would calculate the taxes that were owed on the transaction. In practice, you'd probably want the company's CPA or somebody else to do this, but you should understand how this is done, and certainly you should understand that when you sell an asset, there's going to be tax consequences, and you need to have some idea what that's about. Now, there's three things that we're going to learn in this set of videos here that we're about to go through. One is, how do you calculate the depreciation expense per year? Now, what I'm going to show you in here is simply straight line depreciation. It's the easiest sort of depreciation to do, I think. Also, though, I just want you to understand that there are a lot of other ways to calculate depreciation expense. This is an accounting course, so I'm not going to bring you through a whole bunch of those. We're just going to do straight line depreciation. In the textbook, when we work some problems, you'll see in some of these problems, we use MACRS, which is Modified Accelerated Cost Recovery System, which is a depreciation technique that lots of companies use. But we want to calculate and show you how you calculate depreciation expense per year. Depreciation expense now, this helps the company avoid paying taxes. Depreciation expense, in essence, is the amount of income you avoid paying taxes on each year. So that's a good thing for a company, and you should have some idea of what depreciation expense is. Depreciation expense also has an impact on what's called book value. Now, when you sell an asset for more than book value, there's always going to be tax consequences. And again, we're going to go into that in this set of videos and explain all that to you. You should also know how to calculate taxes, and there are different taxes that impact different sorts of gains on assets when you sell them. And so I'm going to introduce you to the different types of gains that you can have on the sale of an asset, and then what the tax consequences are of the different types of gains that you have. So what we're going to do in this set of videos now is bring you through the sort of the basics, if you will, but I want you to have an understanding of why it is we depreciate assets, how does it lead to tax consequences, and what are the questions that you should be asking as a financial manager. And that's what this set of videos is about, and we'll get on to that right away.